when the cost sheet is prepared, so after prime cost, instead of accounting for the overheads as the factory overheads are added, and then after the factory overheads, we see that in the order we have administrative overheads, then selling and distribution overheads, they are added. This is the way in which the cost sheet is prepared. But then under each of these category of overheads, there are many items of overheads. So they have to be appropriately divided and distributed among the cost objects. Cost objects or cost units, they have to be divided and distributed. But because it's a very lengthy process, there are many items and then each one of them have to be divided and distributed. So what they generally adopt is, instead of dividing them, for all of them, all the items which are there under each category, for all of them, there is one predetermined overhead rate which is taken, and accordingly, the amount of overheads are calculated. So what does that mean? See, from the past data, they observed that what was the relationship in that particular cost sheet about the any item of the prime cost. Usually, it is direct labor. So, if it is direct labor is taken to be as 100%, factory overhead is what percentage is already calculated, and then every time a cost sheet is prepared or a planning in terms of cost is taken up, so the same percentage will be applied. So factory overhead is what percentage is calculated. That is a predetermined overhead rate, and that rate is used to calculate the overhead. So there is an overhead absorption rate which is calculated. Usually we see the direct labor, sometimes it is direct labor hours, machine hours, or prime cost, or anything it could be. But generally we see that it's direct labor hours. So here it says that total budgeted overhead cost divided by budgeted quantity of absorption base. So there is a rate which is calculated. Every time the same rate is applied, the percentage which is calculated is applied. Um, every time a cost sheet or a planning for cost budgeted cost sheet is prepared, so they use this. Okay, so the three most common absorption bases are units produced, machine hour rate, and labor hour rate. Okay, so then when this rate is applied, will it be precisely the same amount of as much overhead is which is incurred? It is not possible, because some of the items may be absolutely unconnected to the base. If let's say that if the base is taken as labor hour, and if the product depends too much on machines, so automation and all, so in that case there would be very less amount of overheads which will be charged to that particular product. But was that overheads are incurred very less for that? No. Since the dependence of that particular product on machineries is more and less on labor rate, and if the rate is calculated based on labor rate, less amount of cost will be charged to that particular product. So there are so many issues with that it would not be precisely calculated. The total amount which has to be allocated to each product will not be 1 second. cost. So the overheads can be charged more in amount or charged less in amount. See, over absorption is overhead absorbed is more than the overhead expenditure incurred. Amount of overhead over absorption or under absorption happens. So we will look into the questions related to that. Um, what is absorption costing and what are the advantages and disadvantages? Absorption costing takes into consideration all the costs. You know that absorption costing is studied in contrast with marginal costing. So what we need to understand here, the difference between that. See, both of them um, are costing methods which are used. The difference part of it here in case of these two methods is the way they treat the ending inventory is uh, what we have to look into in this particular situation. One classification of cost is costs are classified as manufacturing costs and non-manufacturing costs. So there are two different types of costs. So all those which are incurred to produce the product is manufacturing cost. Anything which is incurred other than production, like administration, selling, and distribution, these are the costs which are non-manufacturing costs. Both of them can be categorized as variable and fixed. So the manufacturing cost which is variable, the manufacturing cost which is fixed. Okay. So here in the difference between absorption costing and marginal costing. What is the concept of marginal costing? Marginal costing says that the cost should be classified as variable and fixed. So from sales minus the variable cost is a profit, but total cost is not deducted. So this is also a profit only by deducting variable cost and then deducting the fixed cost to arrive at what is profit. But generally, the absorption costing talks about from the total sales revenue, the total cost is deducted and arrive at the profit. But marginal costing suggests that because fixed cost does not change at all, it remains the same until it reaches the until it reaches the maximum level, the 100% capacity level, it doesn't change. So any decision which is taken, there is no impact on that. The cost doesn't change. Therefore, it is irrelevant for decision making. Therefore, only the variable cost is relevant for decision making. Then understand what is the relevant profit by deducting the relevant cost from the revenue, which is called as contribution. So sales minus variable cost is contribution. This contribution generated will take care of the fixed cost, and the resultant figure is called as the profit. Now that is how it is identified and treated. It treats the variable and the fixed cost. Absorption costing, on the other hand, does not make any distinction between whether it is variable cost or fixed cost. The total cost is deducted and the profit is generated. Fine. Now, if that is the way, the difference in these two things arises when, in terms of how the ending inventory is treated. The ending inventory is the closing stock. How is it treated is what is. See, when production is taken up, the number of units which are produced is taken up, and if suppose there is any opening stock, so opening stock plus production is the total cost of all the units which are produced or which are available for sale. Out of that, out of that, a part of the units are sold, sales happen. A part of the units are unsold, which is called as closing stock. So what is absorption costing does? Absorption costing calculates the total manufacturing cost incurred in terms of the variable component, and the fixed component is taken into consideration, and the cost for the closing stock is proportionately calculated. For the sales, what is the cost of goods sold? It includes variable and fixed cost. Similarly, for the closing stock also, it would include variable and fixed manufacturing cost. But on the other hand, marginal costing, at the time of treating the closing stock, only the variable manufacturing cost is charged as only the variable manufacturing cost is charged to the closing stock. Okay, there is no portion of fixed cost which is charged to the um, closing stock. That is the concept. That is the main point of difference between what is absorption costing and what is marginal costing. Did you understand that part of it? Then, to the extent whatever are the questions which are covered in the examination kit, we will take it up, and any explanation which is needed, I will take it up, and then and there, and I'll explain. The the syllabus or the number of questions which are there in the examination kit are 260 plus questions are there. Many are numerical questions, the rest of them are theoretical. Theoretical ones I will not touch because the time will definitely be not sufficient if we take up all the questions. So only we'll focus only on the numerical questions. At the time of answering those questions, any explanation, further explanation needed, that also I will take it up and then do that. Okay, as of now, just understand that meaning about what is absorption costing, what is marginal costing. Marginal costing charges only the variable manufacturing cost to the closing stock. The rest of the costs are deducted in the income statement, whereas absorption costing proportionately charges an amount to the closing stock. So that is the treatment. From the examination kit, I will put you to the exam kit. Before question number 7, all of them are theoretical questions. Okay, theoretical questions, you please take it up because time definitely will not be sufficient. From my experience, I'm telling you. Even if we do only the numerical questions also, um, exact time will be required. So if later on, if there is any time you want me to answer any of those theoretical questions, I will take it up. But as of now, we are not even looking at them. None. First one is seventh question. A business reported a marginal cost costing profit of 45,000 last period. Its inventory values for the period were as follows: opening inventory, closing inventory. There, if the business had used absorption costing, the inventory values would have been as follows. What would have been the reported profit under the absorption costing? So we'll work out all the numerical questions in Excel file. So let's take the question to the Excel file and then work it out. Okay. I hope you are able to see the Excel sheet on the screen. Let's solve this one. Question number 7. A business reported a marginal costing profit of 45,000. What's the point of difference between marginal costing and absorption costing? That is the way in which the closing inventory is treated. The closing inventory would be valued at, see, under absorption costing, the full cost is charged. Under the marginal costing, only the variable manufacturing cost is charged to ending inventory. So the way in which these inventories are treated is different. Fine. And marginal costing reported a profit of 45,000. We are asked to find out what would have been the reported profit under absorption costing. So it's kind of a reconciliation what we have to prepare. We have to reconcile these two profits. We know what is the profit as per marginal costing. There is a difference in which the ending inventory is treated. So ending inventory according to absorption costing should be 36,400, whereas they have taken only 20,800. It should have been 36,400, but they have accounted for only 20,800. Fine. So that is one point of difference. Any period's closing inventory will go to the next period as opening inventory. Opening inventory, they have taken it as 16,000, whereas it should have been 28,000. We start with what is marginal costing profit, arrive at what is absorption costing. So let's see what is the treatment of that. So to begin with, let's start with um, marginal costing profit given is 45,000. Now there is a difference in treatment of two items. First, the opening stock. So the opening inventory, the second one is the closing inventory. Okay. Um, Opening inventory should have been 28,000 according to absorption costing, but marginal costing has taken only 16,000. See here, if we have the T form of the account, we have the opening stock, then the production cost, then we have the sales value. So sales are rather cost of goods sold on the credit side, and we have the ending inventory. So that is the closing stock. So these are the items what we have. Production and closing stock, both the methods would be the same. There is no difference in that. Or the difference is in terms of the stocks. Now there is a profit, which means that credit side is greater than the debit side. So there is a profit. profit as per marginal costing. So the difference in treatment of that is so now we are starting with the profit as per marginal costing. So what did they do according to marginal costing? The marginal costing profit was arrived as this was added to the production cost. This was added, but whereas this should have been we see opening stock plus production on one side. So profit is equal to these two things go to the other side. Okay. So profit is equal to sales plus closing stock minus, I'll write it. Writing is much easier. Profit is equal to, we have sales part of it minus plus closing stock minus these two things come to the other side, that is the opening stock minus the production cost. Closing stock minus opening stock minus production. Now this is the equation. So their profit was deducting some amount of 16,000. But how much should have been, if we are talking about marginal costing, 16,000 only was deducted. But how much should have been deducted according to absorption costing? The amount of uh, opening stock which has to be deducted should be 28,000. They already deducted 16,000. Now how much more has to be deducted? The difference between these two is 12,000. So 12,000 has to be deducted. More amount of opening stock which has to be deducted is 12,000. Closing stock was added. See, sales and production we do not know. Both of them are same in under both the methods. So not considering that, the treatment would be only in terms of what is the treatment of opening stock, what is the treatment of closing stock. So that part of it has to be taken into consideration. So then what should we do? The closing stock part of it, the difference between the closing stock has to be treated here so that we can arrive at what is the absorption costing. So the increase in opening inventory, the um, difference in opening inventory would be okay. Then add the difference in closing inventory. The difference in closing inventory is 36,400 minus 20,800 is the difference in that. That has to be added. So now find out what is the profit as per absorption costing. So here 45,000 minus 12,000 plus 48,600 is the profit as per absorption costing. Then the next one is question number 8. Okay, students have joined. I didn't really look into that. Good. Question number 8. A company has a budget to produce 5,000 units of product B in December. The budget for December shows that for product B, the opening inventory will be 400 units and the closing inventory will be 900 units. The monthly budgeted production cost data for product B for December is as follows. Okay. Variable direct cost, variable production overhead, total fixed production overhead cost. The company absorbs overheads on the basis of the budgeted number of units produced. The budgeted profit for product B for December using absorption costing. A company has a budget to produce as 5,000. Out of that, the opening inventory is 400, closing inventory is 900. Okay. Um, the total fixed production overhead cost is 29,500. Total variable cost per unit is 9.50. Fine. Um, the question asked is, what is the budgeted profit for product B for December using absorption costing? So, absorption costing, how much is the profit? The options which are given is in comparison with the marginal costing. They are not straight away asking what is the profit. What is the profit? Profit can be calculated as the sale value um, plus the closing stock value minus the opening stock value and the production value when these are deducted. In this question, we do not have what is the selling price per unit. So sales value cannot be calculated. Production value also cannot be calculated. Only cost details which are given is, we have set of details, that is the variable cost, that is 9.5, and the total fixed production overhead cost is given, which is 29,500. Then if we were asked to calculate, if we are asked to calculate absorption profit, the regular procedure should be the selling value at the closing stock value, then minus the opening stock value minus the production cost value, then we arrive at what is profit. But see, we do not have that. But and moreover, the options which are given here are, all of them are in comparison with the marginal costing. One second. Okay. So now this is in comparison with the variable cost. The difference between the absorption costing and variable costing, as I have mentioned, that it is in the way in which the inventory is treated. The inventory will be proportionally calculated. That is, both the variable cost plus the fixed cost, whatever is the production variable and fixed cost, these costs are proportionately charged to the ending inventory, but variable cost charges only the variable cost to the ending inventory. So fixed cost is not considered at all when it is charged to the ending inventory. Ending inventory will go to the next period as opening inventory. So the impact is seen both in ending inventory and beginning inventory. So the proportionate cost of fixed overheads are not included in case of marginal costing. They are not charged in case of marginal costing, but they are charged uh, in absorption costing. Absorption costing takes into consideration even the fixed cost. So fixed cost is how much? 29,500 per unit. How much is that? Is what first has to be understood. We have to calculate what is the per unit fixed overhead cost, which has to be charged to each of them. Each of these units is what has to be looked into. So 29,500 is incurred for the production of how many units? For the production of 5,000. So let's first calculate what is fixed production overhead cost per unit. Is equal to 29,500 divided by, this was incurred for the production of 5,000 units. So is equal to, check that, 29,500 divided by 5,000. Okay. So each unit, the rate comes out to be as 5.9. So 5.9 is charged more in absorption costing. 5.9 per unit is charged more in absorption costing for ending inventory. It is charged less in marginal costing. So 5.9 per unit is charged more in absorption costing. This proportionate allocation, it is allocated as 5.9 per unit in absorption costing. That 5.9 per unit is not charged because only the fixed is there. Only the variable is there. No fixed is there under marginal costing. Now, so whatever treatment is done for ending inventory, that will be reflected in the next period as the beginning inventory. So in the previous period also they might have done the same thing. So the beginning inventory would come here. So here, what we need to understand is how are these things which are charged. Production is the same, 5,000, 5,000, both the things. It is the difference in the inventories. That is, the opening inventory is 400, closing inventory is 500. Closing inventory is 900. The difference in inventories is 500. So in terms of those additional 500 units, this rate of 5.9 per unit is applicable. 5.9 per unit. So 5.9 per unit into 400, 5.9 per unit into 900. Overall impact is additional 500 units, the impact would be there. Sorry about the disturbance. So additional 500 units. So now the impact will be for 500 units. Each unit at the rate of 5.9 will be charged more in case of absorption costing, less in case of marginal costing. So the ending inventory value under absorption costing will be affected. Absorption or marginal costing will be affected to the extent of 500 units. 500 units into 5.9. So the impact of this would be applicable for 500 units into 5.9. So 500 units into 5.9 will be, we got 2950, then 2950. So which one will have more profit, which one will have less profit? That is what has to be looked into. Which one has more profit, which one has less profit is what we need to understand that. In case of absorption costing, see the ending inventory charged more value of ending inventory is there because the fixed portion of the production overheads is also charged to ending inventory. So ending inventory value here it is more high. Ending inventory value is high. Under marginal costing, ending inventory value is low. If the ending inventory value is high, what does it imply? What does it indicate? Ending inventory value. See, the total costs are accounted for on the debit side. See, we have the opening stock, we have the production cost. From this, the units which are sold, cost of goods sold is deducted here. The sales part of it is deducted. Then closing stock, it is not in deduction. It is an adjustment of deduction of the cost which is transferred to the next period. So if the ending inventory is at a higher value, what will be the impact on the profit? So that is what has to be looked into because we are asked to find out what is the impact of this statement of ending inventory on the profit is what we have to understand. So low amount of this is deducted. If this is low, what will be the profit? If the ending inventory is deducted low, then what will be the impact on profit? So that is what has to be looked into. Credit side versus the debit side. If the credit side is low, profit also would be low. If the credit side is high, the profit also will be high. That's the impact of that. I'm really sorry for this disturbance. Just a minute. Okay. So if the credit side is more, profit will be more. Gross profit would be here. The profit part of it is credit side minus debit side. Profit will be more. If the credit side is low, profit also would be low. So now we see that marginal costing closing inventory is low. So what will be the impact on the profit? Profit also, what will be the impact on profit in case of marginal costing? What will be the impact on profit in case of absorption costing? That is what has to be looked into. So you tell me what will be the profit under absorption costing? Anyone? Out of these four options, because 2950 is the value, so C and D are ruled out. We are left with A and B only now. Between A and B, which one is the correct answer? Whether it is A or whether it is B. So 2950 lower than, will absorption costing have lower profit than marginal costing, or will absorption costing have will have higher profit um, than the marginal costing? So just tell me, if this is high, if credit side is high, the profit also will be high. That is the impact of that. Which one has a higher ending inventory? Absorption costing. So profit under absorption costing also will be high, and here it would be low. So on that note, what is the correct answer? Answer is B. It says that dollar 2,950 greater than it would be. See, in case of the difference between these two techniques is that fixed cost, um, the whatever are the production cost which are incurred, production cost will have both the variable component and the fixed component. So variable plus the fixed component would be incurred. So out of these units, the produced units, if a portion of the units are not sold, which is closing stock, absorption costing charges these costs proportionately. So let's say they have produced 1,000 units. For 1,000 units, this is the cost. 200 are ending inventory. Proportionately for whatever is 200 units, the cost is charged. This is under absorption costing. But under variable costing, for these 200 units, only the variable component is charged. Fixed cost is not charged. So ending inventory value will be less in case of marginal costing. In case of absorption costing, ending inventory value will be more because both the variable component and the fixed component will be calculated. Okay. So if the ending inventory is high, the profit also will be high. If the ending inventory is low, the profit also will be low. Because ending inventory is on the credit side. If the credit side is more, if we take the trading account, the conventional method of trading account, if the ending inventory is high, profit will be high. If the ending inventory is low, profit also will be low. So on that note, we see that option B is the right answer. Any doubts, you stop me. Only this absorption costing, marginal costing is little confusing. The rest of the topics will be much simpler and easier. Don't worry. Um, it takes time for the concept to sink into the mind only with the absorption costing and marginal costing. One more time I will revise. Don't worry about that if it is little confusing at this point of time. Um, first, let that first understand the concept of what is the treatment of um, the ending inventory under absorption costing and under marginal costing. So one more question, let's look into that. Then we'll see what it is. Question number 9. A company operates a standard absorption costing system. The budgeted fixed production overheads for the company for the latest year were 330,000 and the budgeted output was 220,000 units. At the end of the company's financial year, the total of the fixed production overheads debited to the fixed production overhead control account was 260,000 and the actual output achieved was 200,000 units. The under or over absorption of overheads was it 40,000 under absorbed or over absorbed, or 70,000 under absorbed or over absorbed? So that is the point. First, what we need to understand is when does that situation arises about under absorbed or over absorbed? When it is compared with the actual overhead. What are the actual overheads? The actual overhead amount, how much do we see that? The budgeted fixed production overhead for the company last year were 330,000 for an output of 220,000. That is one set of information given. At the end of company's financial year, the total fixed production overhead debited to the fixed production overhead control account was 260,000. So in the current year, the actual amount of overhead which was debited to the overhead control account is 260. So that's the actual total amount of overhead cost. So the actual cost is 260,000 and the output achieved was 200,000. But the normal practice is, how do they do? Take the output and multiply it into overhead absorption rate. So step number 1, we have to find out what is overhead absorption rate. How is it calculated? From the past data, there is some overhead absorption rate which is calculated. So let's check this one. Overhead absorption rate is equal to the total amount of overheads last year incurred were 330,000 for an output of 220,000. So that would be converted into some rate. So that comes out to be as 1.5. So this year also they will calculate it at the rate of 1.5 per unit and charge the overhead. So technically, every period they do not exactly divide and distribute the overhead cost. They just assume some rate which happened in the past, apply it to the present also. This year's current actual overheads are actual overhead cost. What is the amount of actual overhead cost which they have incurred? They have incurred 260,000. That was debited to the control account. How much would they have charged as the overhead? Overhead absorbed is equal to, which means that this was shown in the books of accounts. So the way they would have calculated is, rate they got it as 1.5. 1.5 into how many units this year? 200,000 units this year. So that is equal to, this is 300,000. The actual amount is only 260,000, but they have accounted as overheads as 300,000. It should have been 260, but they ended up charging more amount. So that is result of over absorption. Over absorption of overhead is they charged more. The actual incurred is only 260. But because they adopted a rate from the past, which is 1.5 per unit, and the current year's production is 200,000 units. 1.5 into 200,000 comes out to be 300,000. So over absorption of overhead would be the difference between these two. They charged more than what actually was incurred. That's 40,000. Answer is A. Question number 10. A business manufactures a single product which sells for 45 per unit. The budgeted data for the latest period are as follows. Production and sales volume is 2000 units. Material, labor, production overhead, non-production overhead. Then actual production volume and cost were as budgeted for the period, but the actual sales volume achieved was 1800 units. There was no inventory at the beginning of the period. The profit for the period using the absorption costing is, okay, production and sales is 2000. They produced these units, fine. Then they sold 1800 units. So what's the ending inventory? The ending inventory is 200 units. So for this 200 units, we have to calculate the value and then arrive at what is the profit as per absorption costing. How do we calculate what is profit? Sales minus all the other costs, okay, cost of goods sold. What is cost of goods sold? Opening inventory plus the production minus the ending inventory is cost of goods sold. So that is the concept. Um, we are asked to find out what is the profit as per the absorption costing. How do we calculate what is profit? Sales. Sales is how many units are sold. They sold only 1800 units. Each unit is sold at a rate of 45. That's the first line. Just check that. The first line talks about the selling price per unit. So 1800 into 45 gives us sales value. From this, if we deduct what is cost of goods sold, we get what is profit. But how do we deduct what is cost of goods sold? Cost of goods sold will be the opening stock. There is no opening stock. Opening stock plus all the production costs, okay, minus the opening stock. So cost of goods sold, cost of goods sold is equal to, we have opening stock plus the production cost minus the closing stock, the value of closing stock. This is the equation. So what should we do? No opening stock. So there is one production cost, one um, closing stock. Only two items are there. So find out what is the production cost. Production cost anyway is given there. Material cost, direct labor cost, production overhead, non-production overhead. So all these costs are production costs. From these production costs, the closing stock has to be calculated. So first we need to find out what is the value of closing stock. Then only we will be able to proceed further. So value of closing stock. is equal to. How do we calculate what is the value of closing stock? So it is actually a proportionate amount. Proportionally, it has to be calculated. Um, Production cost is equal to 13,500 plus 11,800 plus 32,400 plus 21,900. Check that how much is it? That is 79,600. Is that so? Anyone working along with me? Is it 79,600? Okay. This doesn't have 20. That is non-production. Nobody is telling me. That's non-production, no? So production cost is 57,700. Production, this is non-production. Please look at it. Anyone following me? No response from your side. This is non-production, non-manufacturing. Now, value of closing stock. Value of closing stock is proportionate calculation. If for production of 2,000 units, it is 57,700. Ending inventory is 200. How did we get 200? Ending inventory is 2,000 produced units minus 1,800 sold units. Ending inventory is 200 units. So if this is for 57,700 is the cost. Cost for how many units? This is incurred for 2,000 units. So value of ending inventory, which is equal to 200 units. How much is it? If for 2,000 it is 57,700, for 200 units, how much would it be? Anyone please respond. Please respond. At least one student please respond. Hisham, nobody is following. Say something. The value of closing inventory would be 57,700 into 200 divided by 2,000. 5,770. So what has to be done now? Sales value is 81,000. From 81,000, there are two things which have to be treated now, which is production cost has to be treated and ending inventory has to be treated. Okay. So the cost of goods sold has to be calculated. What is cost of goods sold? What is cost of goods sold? Production cost minus the closing inventory. Production cost, we got it as 57,700 less closing stock. Closing stock is 5,770. So the cost of goods sold is this cost of goods sold has to be deducted from sales. So that is 81,000 minus 51,930 talks about what is profit. So gross profit is 29,070. After gross profit, there are again non-production costs also incurred. Non-production costs are 21,900. So profit profit using absorption costing is 7,170. Any doubts, anyone? Is it clear? At least that you tell me. Am I audible? 7 students are there. Not even one student is responding. The same set of data, we see, but this time they are asking us to find out what is the profit as per the marginal costing. The same set of data, here what we see. At least one student respond, no? I don't know whether you're there or not. The same set of calculation would be taken up, but with the difference that the ending inventory will not be having the set of calculations would be this way only, but the treatment of ending inventory would differ here. So here it is question number 12. The working notes also, the working notes part of it will differ. Ending inventory is 200, but the point here it would be, it is not just the total production cost, but we have to restrict it to variable production cost. Variable production cost will be only 13,500 and 11,800. Direct material, direct labor, we see that production overhead 32,400. There is no mention about direct, so it is assumed to be as a fixed cost. So if it is fixed cost, variable production cost will be see 13,500 plus 11,800. Only this much will be the total variable production cost, 25,300. If it is 25,300, ending inventory anyway is 200. So for the ending inventory, it will be 2,530. So variable production cost, the total production cost is 57,700. Ending inventory will be only 2,530. So 2,530 is the ending inventory. Non-production costs are the same. So profit here is 3,930. Please make a note of this changes. Please write the values. If you have a doubt, please raise the doubt. Students, please respond, students. First thing, let me find out, am I audible? Now, why are you not responding? I'm asking so many times, is it clear? Is it clear? You're not even saying yes or no or any doubt or anything. Okay. Network issue. Not even one student. See, for every question, after every question, I've been asking, is it clear? Any doubt? You're not responding, so I did not know what was going on. So I thought maybe I'm not audible. Therefore, I put a message that am I audible. Did you understand the difference between these two methods in this particular question? See, beginning I was explaining to you about the differences with in terms of the way the closing stock is treated. Here under absorption costing, there was no distinction made as to what is variable component and fixed component. All that cost is added. So for the production of 2000 units, the total cost incurred is 57,700. So proportionately 200 units, how much is that? So that was taken, and then we calculated what is cost of goods sold. Cost of goods sold is opening stock plus production cost minus closing stock. So opening stock anyway is not there. Production cost minus closing stock is cost of goods sold. That is deducted gross profit. Non-production costs are deducted. Profit using absorption costing. But the same scenario, if it is applied for marginal costing, uh, the marginal costing ending inventory, under marginal costing ending inventory will be only the variable production costs are charged proportionately. So variable production costs are 13,500 plus 11,800, which is 25,300 for 2000 units. For 200 units, how much? So we got it as 2,530. Production cost anyway we know that, which is 57,700. 1, 2, 3, three items is 57,700. From that, closing stock is 2,530 deducted. We got it as this one is gross profit. Deduct non-production cost, which is 3,930. So we see that difference between these two methods. Absorption costing has a higher profit of 7,170. Marginal costing has a profit of only 3,930. Do you see the difference between that? Absorption costing gives a higher profit, marginal costing gives a lower profit. So we were trying to understand the difference here in the question number 8 also. Ending inventory, because it is high, profit also would be high. Marginal costing, profit would be low. So that is what we were trying to figure it out. Now this is a full length problem. So we see the difference here. Absorption costing profit is definitely greater than the marginal costing profit, because a major portion of the cost is transferred to the ending inventory. So profit is high under absorption costing, whereas in this case, profit is low in case of marginal costing, because the value which is taken to the next period and as closing stock, lesser amount is going there, more amount is getting deducted here. That's the logic there. Any doubt? Uh, are you all there in a group, WhatsApp group? Add me also into that group, no? If you're there in a group. Question number 13 says T uses a standard labor rate to charge its overhead to its client's work. During the last annual reporting period, production overheads were under absorbed by 19,250. The anticipated standard labor hours for the period were 38,000 hours. while the standard hours actually charged to clients were 38,500. The actual production overheads incurred in the period were 481,250. The budgeted production overheads for the period were. During the last annual reporting period, production overheads were under absorbed by 19,250. The actual overheads incurred, the amount spent was 481,250. But because they were under absorbed by 19,250, how much was absorbed is what we have to look into. Then the anticipated standard labor hours are 38,000, but while the standard hours actually charged to the client are 38,500. They planned for 38,000, but they spent 38,500. So this is a difference of 500 hours. Now, the question is, what are the budgeted production overheads for the period where? 13th question. Actual overheads incurred are 481,250. They have under absorbed by 19,250. So they have charged less amount by 19,250. So how much did they were supposed to charge 481,250 according to the actual, but they ended up charging less. That's why it's under absorbed. So how much did they charge? They charged, which is 462,000 only they have charged. Okay. The question is asking us what should be the budgeted production overheads for the period. What did they anticipate? They've anticipated that this the anticipated standard labor hours for the period were 38,000 hours, while the standard hours actually charged to the customers are 38,500. There are two different standard hours mentioned. They actually planned to have the overheads based on 38,000 hours, but during that period they have they had it as 38,500. The actual production overheads incurred in the period were 481,250. This 462,000 would be calculated based on the number of hours, the number of hours into rate per hour. Whatever is the rate per hour into the number of hours is the overhead absorbed. So how do we calculate? I'll put it here. This would be based on overhead rate into number of hours. So when they have the overhead rate multiplied into number of hours, they would get the amount of overhead. Okay, how many hours did they actually use in the current period? 38,500. So whatever was the rate, that rate into 38,500 is 462,000. I hope you understood. How did they arrive at 462,000? 462,000 would have been based on some overhead rate into 38,500. So overhead absorbed is equal to 462,000, which is equal to overhead rate into how many hours? How many hours did they spend? They have spent 38,500. 38,500. So from this information, can we calculate overhead rate? We can calculate overhead rate is equal to 462,000 divided by 38,500, which is equal to which comes out to be 12. Initially, they planned the overheads for 38,000 only. So, what are the budgeted production overheads? So, budgeted is equal to, they have planned it for 38,000, 38,000 into 12, which is equal to 456,000. WTD Limited produces a single product. The management currently uses marginal costing but is considering using absorption costing in the future. The budgeted fixed production overheads for the period are 500,000. The budgeted output for the period is 2,000 units. There were 800 units of opening inventory at the beginning of the period and 500 units of closing inventory at the end of the period. If absorption costing principles were applied, the profit for the period compared to the marginal costing profit would be how much? The management currently uses marginal costing but is considering using absorption costing in the future. The budgeted fixed production overheads are 500,000. Budgeted output for the period is 2,000 units. Opening inventory is 800 and closing inventory is 500. If absorption costing principles were applied, the profit for the period compared to the marginal costing would be. We see beginning inventory is 800. So now the difference in the units is by 300 units. So the difference is with the difference in profit according to these two methods is on account of the inventory levels. So the impact is inventory is reduced by 300 units. So the impact also will be to the extent of that. So that will be absorbed at the rate of whatever is the fixed production overhead. Fixed production overhead per unit is what is the first step what we have to calculate. So fixed production overhead per unit, because the difference is in terms of fixed production overhead only. $250 per unit. So the amount of ending inventory, which is 500 units, the difference in the number of units is 300 units. So the impact will be for these 300 units only. 300 units at the rate of 250 per unit. So 250 per unit, the difference is 300. So 300 into 250. 300 into 250 is 250 into 300 units, which is equal to 75123. The question asked is the profit for the period compared to the marginal costing period. Marginal costing profit will be higher or lower. 75,000 lower than the profit as per marginal costing. I think that's it. The questions, numerical questions which are there under absorption costing and marginal costing. One more is another two. Let's take up one more question. Question number 16. X Limited has two production departments, assembly and finishing, and two service departments, stores and maintenance. Stores provides the following services to the production department: 60% to assembly and 40% to finishing. Maintenance provides the following service to the production and service departments: 40% to assembly, 45% to finishing, and 15% to stores. The budgeted information for the year is as follows. Budgeted fixed production overheads are assembly, finishing, stores, maintenance. Budgeted output is 100,000 units. At the end of the year, after apportioning the service department overheads, the total fixed production overheads debited to assembly department fixed production overhead control account were 180,000. The actual output achieved was 120,000. The under over absorption of fixed production overheads per assembly department is dash. Are you aware of how the production department and service department overheads are charged to production department overheads? Did you ever learn that apportionment of overhead costs, service department overhead costs to production departments? You have to respond. Then I can teach that and then go ahead explaining this one. You have to please respond. Okay, done. So you also now you mentioned that. See, there are broad classification of that is there are two different types of departments. One is service departments and the other one is production departments. So the practice of service departments, let's say that, for example, if we see there are two service departments S1 and S2, and there are two production departments P1 and P2. There are various practices or various methods of how the service department costs are charged to production department. What is the purpose of that? See, one of the objectives of cost accounting is to ascertain what is the cost per unit produced. So, for every product, every single unit of the product which is produced, what is the cost which is incurred. But then costs are not always incurred only in production department. They are incurred in service departments also. So these service department costs have to be taken and they have to be charged to the production departments. So service department 1 has to be charged to production department 1 and 2. Then service department 2 also will go to production department 1 and production department 2. That's a normal way. There are methods here again. Methods here about what is the direct method. So service department will not charge anything to the other service departments. They only focus on charging to production departments. Then they are reciprocal. That is mutually among these service departments also. One department charges render services to the other one. In turn, they also um, take services from the other one. So there should be mutual charging of one to the other department also should take place. Here in this case, the method which they are adopting is, it's called as first let's look into that, then I'll tell you. Stores, what are the service departments, what are the production departments? Let me clearly write that first. This is question number 16. um, from this information, what we understand here is there are two production departments. Um, there are two production departments. One is called as assembly. The other one is called as finishing. There are two service departments. One is called as stores. The other one is called as maintenance. Okay. Now, all the costs of service department ultimately have to be charged to the production department, these two, assembly and finishing. First way, one, stores department. It says that stores department is charging 60% to assembly, 40% to finishing. Stores department will be charging only to assembly and finishing. There is no mention that there is anything which is charged to maintenance, that is missing here. 60% will go to assembly, 40% will go to finishing. Whereas maintenance says maintenance provides the following services to the production and service department. Maintenance will charge to assembly, maintenance will charge to finishing, maintenance also will charge to stores. Do you see that? One department, one service department is only charging to one service department is only charging to the remaining production departments, but another maintenance department is also charging to the other service department. So this is called as step down method. The reason why it's called a step down is um, we will change the order. We will change the order, then only it becomes, I will write it as service here and then production here. Then this should be, first of all, I will write it as maintenance. And this will be stores. This is assembly and finishing. Maintenance, stores, assembly, finishing. So first we start with maintenance. Maintenance amount will be taken and charged to, maintenance will go to stores, then it will go to assembly, then to finishing. But stores will happen only to assembly and finishing. So when we look into that, it looks like steps. Do you see that? That's why it's called a step down method. So that is the method which they are following. From the information, given information, what we can understand here is one service department is charging to the other service department plus the production departments, but the other service department is charging only to the production departments. Fine. Now that's the primary information, and the amount of overhead costs are also given for assembly, for finishing, for stores, for maintenance. We have the set of data which is given. For maintenance, it is 40,000. Then we have it as stores is 50,000. Then we have it as 150,000. Then we have it as 100,000. These are the four amounts, budgeted overhead amounts for maintenance, stores, assembly, and finishing. After that, the apportionment has to start. The apportionment of the cost has to start. So first we start with the maintenance. Maintenance is okay. So apportionment. So take 40,000. Take 40,000. Charge it to all the other departments. So of this 40,000, what percentage goes to stores? 15 is equal to 40,000 into 15%. Then assembly it is 40%. So nothing is left apportionment. First, we are starting with maintenance. Next, we start with stores. Now, stores already has 56,000. Do you see that? 50 of its own, 6 it is taking from maintenance. So total 56,000 has to be apportioned. So we start with stores. Take stores and then apportion it to the other two departments. So here it will be 56,000 into 60%. Then we have 56,000 into 40%. So now nothing is there in stores. Stores has become 0. Then we have assembly as 199,600 and finishing has 140,400. So these are the amounts what we see. We'll continue tomorrow because it's already time. It's 5:30. Shall we continue tomorrow? Say something. No. Okay, we'll continue with this question tomorrow. And then the tomorrow's class, we will also start the next topic. I think it is activity-based costing. We will start with that also tomorrow. For the moment, I'm ending the session here. I'll see you tomorrow. same time, 3:30. Okay then. Good day.